We want to talk about annuities and the role they can play in your retirement planning. This is part of our retirement segment brought to you by Fidelity Investments. And to help us explore this, we invite into the stream Michael Goodman. He is a financial planner and wealth manager with Wealthstream Advisors. Michael, very simply, an annuity is a contract you have with an insurance company that guarantees you, the purchaser, a stream of income, whether it's immediate, if you buy it today and you start getting it monthly, or deferred, get it in 20 years when you retire. What are the tax consequences? Do you pay a greater tax if you defer, or do you just pay the income tax on the monthly amount you're getting?
That's a great point, and there's actually a pro and a con to that. The beauty of the annuity is that you don't pay the tax until you take the money out. So in a deferred annuity, you're actually allowing to put off that tax until you take the money out, which could be a good strategy. One of the downsides to that, though, is you're taking what might be capital gain income if you were to invest it elsewhere and convert that to ordinary income, because any income that comes out of the annuity that's taxable is taxed as ordinary income, which currently is advantageous to be capital gain. But in the future, if the Biden tax proposal does go through, that might not be such an advantage.
Michael, how should investors be thinking about annuities right now with yields so low?
Yeah, so that's a good point. But, on the other hand, we don't know what's going to happen to interest rates. So it's the same thing how we think about bonds or CDs or other investments. We want to be a little cautious right now, but we also don't want to try to predict where rates of return are going in the future, because that could be a dangerous game. If you're looking for an immediate annuity, which is kind of like a pension, what you might want to do is take a piece of your assets and do an immediate annuity today, but not all of it, maybe just a small portion, wait a little while, see what happens, and then take another one in the future, and in effect, basically create a laddered portfolio of these annuity income streams.
One of the criticisms we hear about annuities are the fees. So help us understand this for those of us who are not accountants. Let's say you got $100,000 and you're buying an annuity. Does the fee affect the amount of money you're going to get monthly from that $100,000 purchase? How does that work?
The fees are all different depending on the type of annuity that you have. And that, by the way, that's one of the reasons annuities are so confusing. There's different types of annuities, and the fees and the features work differently in each type. But in what you're talking about now, in an immediate annuity where you're basically, once again, exchanging a chunk of cash for an income stream, kind of like a pension, then you're really not seeing the fees. The fees are baked into the income stream that you're going to be getting. It is important to shop that around, though, to different insurance companies, and that's the best way to check those fees. The other thing you want to check, though, of course, just like any other income product, is the credit rating of that insurance company to have some good reliance on the predictability of that income stream.
And if it's a deferred annuity, again, the 20 years down the road, do you pay the fees when you start withdrawing, or is it baked into, because the insurance company is going to be making money off of the money you give them to fund that annuity?
That's right. And the fees on a deferred fixed annuity are going to be baked into the rate. And a fixed annuity, you're basically getting quoted a rate, kind of like a CD. We all know that CDs on traditional banks, the bank's making money too. So the way to compete there is just to compete against rate. Where the fees stack up are on what are known as variable deferred annuities. And that's because there's investments inside of those variable annuities, kind of like a 401k or mutual funds. And also there are features that sometimes you can opt for, riders as they're known, that you can check the box and take in features like, say, a minimum guarantee rate of return or other types of death benefits that might occur in there. That's when you start to have fees associated, primarily more in those variable deferred annuities.
I wish we had more time. We're going to get you back because annuities are and can be a foundation, not your entire retirement, but they can be a foundation for a lot of people to retire. Thank you so much, Michael Goodman, financial planner, wealth manager, Wealthstream Advisors. We look forward to having you return.